Good morning and welcome to the Pension Committee. I know for many of you it's a new committee. I think out of the 12 county councillors previously on, we've only got 4 remaining, so everybody else is new. So welcome to you all. I think there's probably quite a bit of learning to do. If anybody didn't attend the induction event a couple of weeks ago, then it's probably worthwhile going into the pension library and having a look at that. Welcome to all those who are dialing in. I see Eric, William, Joe, Greg. I presume Chris is coming on later. So if Mike's ready, we'll make a start.
Ready when you are, Chair.
Okay. Yes, go on.
Good morning. I just wonder whether it might be helpful, certainly would for me, if we could just do a very quick round of introductions to everybody, please.
Okay. Right. I'm Eddie Pope. I'm chair of the Pension Committee. If we go left and then go front row, go on.
Good morning, everybody. My name's Mike Neville. I work in Democratic Services and I'm the clerk of the meeting. I'm sure you've seen the countless emails that I've sent you ahead of this meeting.
I'm Ethan Devitt. I'm one of the independent investment advisors. I'm a double act with Eric Lambert, who's on your screen there.
David Morrow, member of Preston City Council, one of 2 district reps on the pension fund.
Hi everyone, Margaret Patterson, Morecambe Central. I'm new to this committee, so I've got a lot to learn. Thank you.
John Clifford, Cletterworth, Whittle Ward.
Hi, County Councillor Matthew Brown, Preston Central West, new to the committee as well.
Sean Serridge, Mid Rossendale, subbing for Frank de Molfetta.
I'm Gina Dowding, Lancaster Central councillor, representative of the Green Group on this committee, and I've been on the committee for 8 years.
Councillor Mark Smith, Blackpool Council. Yeah, been on the committee for, I think, 10 years plus now. Thank you, Chair. Veteran now.
County Councillor David Wesley, back on the Pension Committee. I was on for 8 years before you break.
County Councillor Mike Goldthorpe, Pendle Rural Division.
Good morning, County Councillor Ron Woolham, Preston Rural East for the City Council and Preston North for Lancashire County Council.
Jennifer Easton, and I'm the co-opted member to represent the HE and FE, so the colleges and the universities in the county.
Paul Crew, and I'm co-opted and I'm representative of the trade unions.
Joan Burrows, I'm the elected member for Penwortham East and Waltney Dale, and I've been on the committee for 4 years.
Scott Smith, the councillor for Whitworth and Bacup. I'm new to this committee, so a lot to learn.
Alan Schofield from Ribble Valley South West. I'm also a continuing member of this committee. Amongst other things, I'm vice chairman of it.
Thank you. Good morning, everyone. I'm Laura Sales. I'm the Director of Corporate Services.
Good morning. I'm Sean Green and I'm head of the pension fund.
I'm not sure what's happened now. Carry on, okay. Right. Okay, item 1 is just to note the decision taken by the full council on 27th of May to appoint myself as chair of the committee and County Councillor Alan Schofield as deputy chair. On item 2, we've got constitution membership of terms of reference. I think we've sorted out the issues on the Conservative group. The vacancy is now filled by Councillor David Wesley, and on the Labour group, the vacancy is filled by Margaret Pattison. I think there's still a vacancy on the trade union side that still has to be sorted out. Is that correct? Yep. Okay. Apologies.
Apologies. I've had apologies from Councillor Whittle and Councillor Hindley, who is another new appointment co-opting member to the committee.
Right. Okay. Disclosure of pecuniary and non-pecuniary interests. Anybody? Any disclosures to make? No? Okay, thank you. Minutes of the meeting held on 12th of March 2021. I think there's only probably a few people can look at these and agree them. So anybody happy with them? Councillor Schofield? Fall through? Yep. Okay. I'm not sure there's any particular actions. I think there was only one relating to item 13 on responsible investment. That the future reporting on responsible investment include a brief synopsis of the fund's progress in reducing carbon and movement towards a net zero position. And I think you'll find that's on page 126 of the overall report. So apart from that, if we can move on to external audit, and I'd like to welcome Andy. Andy who is dialed in. So over to you, Andy.
Thank you, Chair. I'll take you through the audit plan for the external audit. This was taken to the audit committee previously, I think in March or April. So if we
could I just ask Andy, is it possible for you to speak up?
Sure.
Sound isn't very good in this room. You know, so as loud as you can, please.
Okay, I'll project a bit more. So I think if we start on page 4, the introduction and headlines page kind of goes over all the main points which I'll talk through today. So this year we have 2 significant risks. First one is management override of controls. This is a standard risk that applies to all audits completed under our international account auditing standards. So that's going to be mostly looking at areas where management have the opportunity to manipulate the accounts. So that's around journals and areas around like estimates. Our second significant risk is the valuation of level 3 investments, which by their nature are a lot more judgment involved. There's not observable inputs like you would get with level 1 and 2 investments. So we do a lot of work on that. Next, our materiality. This year we've determined it to be 92 million, which works out about 1% of the net assets, and this was based on net assets at the end of February. When we get the draft accounts, we'll update, or we may update depending if there's been a significant movement, but chances are, unless there's a big movement in that month, we'll stick around 92 million. This is similar basis to last year, but last year there was less assets at the end of the year. If we then go to page 5 of the report, which is significant risks identified, there are 2 other presumed risks around revenue and expenditure recognition. The revenue one is standard for all audits, but it is rebuttable. And the expenditure recognition is a public sector specific presumed risk. We've considered those and rebutted them both, and the details of why are on that page. The next page gives details on the work we'll do to address the two significant risks we are recognising. So management override of controls and evaluation of level 3 investments. And then page 7 to 9 is a bit of detail around a new financial reporting standard this year around estimates, which we're required to do more work, and we put a lot more challenge to management, and we've already written to management and the audit members of the audit committee to get responses on these, and we it's an area of a lot more challenge, so we flag it in the audit plan. And then the rest of the report is going through other things in a bit more detail. If we go to page 13, the audit and logistics, we've completed the planning and obviously issued the audit plan in April, and we're due to start the audit next month. So with a target date of, the deadline is the end of September, but we'll be reporting to the audit committee in October. I think that's just to do with timings of committees, but we should get bulk of the work done before the end of September. Last year we didn't sign off until I think it was middle of March, but that was due to a delay on the county audit, and we can't sign the pension fund audit until the county audit has been signed. Page 14 and 15 is looking at the detail around the fees this year. And 16 gives a bit of information about other work we do alongside doing the financial statements audit. We issue some assurance to admitted bodies such as the district councils and police and fire. I don't propose to go into any more detail, so if you've got any questions, I'll be happy to try and answer them.
Okay, I mean, I find it very interesting that the fees, everything's been added on, but nothing's been taken away. But however, I'll let Jennifer Easton has got questions, I think.
Thank you, Chair. So my question was around the fees have increased from 27,000 to 36,39. COVID was added on. I'd like to know what additional work, another for the 6,000 again that you're going to do for COVID, and also £3,000 for revised accounting standards. So every year there are revised accounting standards, that's part of accounting. So why would that go on this year as an addition? So I'd like to explain the COVID, the accounting standards, and as the chair says, why are some of the previous things not coming off its addition each time? Thank you.
Thank you. Sorry, COVID, new standards and additions. So with the COVID, that was to do with the impact of having, a lot of it was to do with the impact of having to work from home and the difficulties that led to, but things just take longer to do. And we can't, doing things face to face in person makes things quicker. And there was just delays last year. Things coming off and being, instead of, rather than everything just being added each year. So last year, the first three on page 15, so raising the bar, further stuff on directly held property and investments, we have to do those every year. Raising the bar comes from the FRC increasing increasing their standards, which means we've got to increase the level of work, and so that's across the board, but then also specifically on directly held property and level 3 investments, and that's sort of again built on again this year with the ISA 540 new requirements. There's further work we have to do on that. This goes back to, like, historically when PSAA took over issuing the last round of audit contracts, the fees dropped by I think about 25%, and the recent Redmond report, and there's been various other reviews at the Competition Markets Authority and the Public Accounts Committee, and our lead audit lead for the firm and our public sector audit lead both appeared at the Public Accounts Committee at Westminster last month, and similar sort of questions were asked around fees, and it's to make the sector sustainable and keep interest in the market amongst audit firms. It's the Redmond review that looked into this in detail has said that fees need to be sustainable, and adding these fees on like this is a means of doing that. And I think in the next round of tenders and contract issued by public sector audit, PSAA, that will be reflected. What isn't shown on here is so on page 16, the IS 19 letters. Last year the fee was, I think, about 15 or 16,000, but that's because we do additional work every 3 years on the updated triennial actuarial valuation. So we have reduced that back to the level of the previous year. So we are not just adding on, where there is reduced work, we do reduce fees. Has that answered your question, or is there any more detail you'd like?
I'm not getting an indication that there's any further questions, but I would just ask the question, basically on the COVID side, presumably your staff working at home is actually cheaper because they're not actually having to come in and travel in to the county. And also, presumably, we can look forward when COVID becomes the norm to a reduction, presumably.
I'd presume so. I think there's reduction in expenses. But I think it's more the difficulty of working rather than the difficulty of working remotely that makes the difference to the additional fees here, rather than reduction in expenses. The expenses aren't a huge amount to the audit fee. And actually, one thing I haven't already mentioned is I think the Ministry of MHL CLG has allotted extra funding to the public sector for additional audit fees in recognition that there is fees are going up. It's not just Lancashire County Pension Fund. It's not just Lancashire County. It's across the board. Fees are going up, and we're working to keep reductions as low as possible. There is additional funding that will be available to councils for that, and we've kept it within the percentage.
Okay, so we'll look forward to your presumption that they will reduce in future. Members, are we happy to note the report and accept the level of fees? All those okay? Just give me a nod. Yep. Okay. Thank you. Right. We move on to agenda item 7, which is the budget reporting. And I'll pass over to Sean, Head of Fund.
Thank you, Chair. So we've now passed the end of the financial year 2021, and we prepare and give budget updates to each meeting of the Pension Fund Committee, and this one covers the full year. As you'll be able to tell from the paper, there was an adverse variance this year against the expectation of net income of 219 million. And in the cover paper, we've run through some of the key variances there. I'll pick up on some of them. In terms of contribution in income, there's been a positive variance there. That's because employers have the option to pay contributions upfront if they want to. So in the year 2021, there were upfront payments received from a number of employers, which led to an increase in employer contributions. And one of the other factors at play as well was a higher than anticipated pay award for employees. In terms of transfers in, they're difficult to predict, but the budget was within tolerance in terms of what was actually transferred into the fund. And then I'll just pick up on investment income. There was a negative variance here, and we did discuss that at the meeting that we had in March. We went into detail on that. It was primarily due to the economic impact of the pandemic. At that point in time, we did explain that there would be a negative variance at the year end, and this has turned out to be slightly higher variance than anticipated, and I've outlined there the couple of reasons for that. The predominant one being around a distribution that's been delayed on the infrastructure fund. So instead of it falling into this year, or the 2021 year, sorry, it will fall into this year, and we'll see it in the next budget. In terms of total benefits payable, again, that was in line with budget, as was transfer out. And then we get to investment management expenses. Here there was a negative variance. This was predominantly due to the fact that the investments performed well, and our investments increased from 8.4 billion to 9.5 billion. And in turn, some of the investment and management fees are based on the value of the actual investments. I've also mentioned some other factors that are at play here, and in some mandates that we have, if the value of investments goes over a certain threshold, then it would not, there'd be some fees that would relate to prior years that would become payable. And then in the final bullet point, I've mentioned that it is quite hard to estimate performance fees. And I've explained that there's a policy that we have there where we recognise that they are difficult to predict, and we recognise them, you know, at the end of the year, really. So that variation, it is large in the quarter, but it's not totally unexpected. And the final point that I'll pick up on is the fund administration oversight and governance fees. Overall, they were in line with what was expected at 5.1 million. There is a bit of variability within there. The main cost that we have is for our administration services, and they came in under budget. However, there were some additional costs in other areas of governance, so it netted out at being equal to the budget.
Okay, any questions, anyone? Jonathan? Don't know which was first. We'll go David. Go.
Thank you, Chair. I mean, I read the report a couple of times before today's meeting, and I don't recall that at the meeting in March, when we were talking about a variance of about 15 million, that we discussed the problems in a way that would lead me to anticipate a difference of 70 odd million. And I would have expected to have been in a position in the middle of March for committee to have been given some information on the scale of the outturn that was a bit more accurate than this. I mean, we met on the 12th of March. I think some of the problems were explained, but when in the first 3 quarters, the difference was about 15 million, and we did talk about, we're not sure about this, we think we've got further problems here and there. It just didn't hit me at all that the additional scale of the problem would be another 50 odd million. And I just would have expected that scale, even if not the precise figure, to have been indicated when we met in March. So that's all I've really got to say, Chair.
Thank you. Linking up to what David says, in the report on page 275, I think, which is in Eric's, or maybe in Williams, it talks about the fund valuation was 9,420 at the end of March 2020, and then 9,468 at the end of 21. So it's only 48 million more. So linking to what you're saying, I couldn't understand, and I have to pass on to the people I'm representing, why the fund has grown this much and the investment fees are basically pretty much all of that amount. So it just seems really, really high. And my second question was, which is probably to Sean, is about there's some quite big variances in the outturn for the year, and your budget is set before the outturn comes through. So does this cause us any challenges for the budget that we've set for the year that we're working through? And is there anything that we need to be having early highlights on? So 2 questions, one linking to David's about the valuation of the fund, the total growth versus the increase in the fees, and the second about, is there an impact to the budget based on the actuals?
If I can take that second question about the budget, I think it would, well, what I plan to do really is to take another look at the budget for this year. We do that every quarter as a matter of course anyhow, but I think anything that we've learned from this budget we can reflect and refine, because sometimes we might have to make assumptions quite early on in the new year, and now we're 6 months later, so we could look to refine that to make it more meaningful and not have unexpected surprises. Do you want me to take your first point as well? Yeah. Yeah. I think that first point is probably more around timing as well. We do actually have Chris Rule here from LPPI, so if we want more detail, we can perhaps hand over to Chris, but timing of how the investments perform versus when the fees arise and when the income arises is not always completely aligned with one another. So sometimes it can look a bit misaligned, if you like. I don't know if you want more detail, perhaps Chris could help out here, Chair.
Okay, Chris, could you make any comment on that, please?
Happy to. Can you hear me okay, Chair? Can you hear me, Chair? Are you able to hear me?
Okay, that's better.
You can hear me now, yeah?
Yes, we can hear you, okay.
Sorry. In terms of the first comment, in terms of fund size, I didn't quite get the page reference, but I suspect we're referring to the investment performance report towards the end, which is comparing one quarter to the next, not the full year. So I think the full year growth that Sean refers to in his budget report is around £1 billion. There was some further growth in the last quarter, but my understanding of Sean's report is the most substantive part of the cost variance is around performance fees. And those typically don't get reported by or charged by the underlying managers until the final quarter. So that those have come through much more rapidly in the last 3 months or so than would have been present beforehand. So Sean and his team wouldn't have had the data earlier.
Right, okay, I mean, clearly, I think, you know, I take David's point that maybe we should have estimated these a little closer and given the committee some more information, and we will look to do that going forward. As Chris says, some of these charges only come through in the last quarter, but I think in terms of our budgeting, I think we need to be a lot closer to the mark on that. And I'm sure Sean will take this forward.
Thank you, Chair. I just want to clarify regarding the prepayments from the local authorities. I know you said they're prepaid up front for 3 years. Is this the first time it's happened, or has this happened beforehand? And if it happened beforehand, why have we made an assumption in the budget that the local authorities will be prepaying? So it gives us more an accurate budget going forward than just a budget that's assuming there's no prepayment. So can we confirm how often the prepayments are made and how the budget is forecast to take an assumption that's happening and going forward as well, please? Thanks, Chair.
Yeah, so prepayments have been an option for some time. It's not new, if you like. The budget would have been based on experience previously. And again, I think it comes down to a timing issue. When the budget was set, it would have been in advance of prepayments actually happening. So we had to make an estimate of how many employers were going to take up that option. So when we do budgeting into the future, we can take into account the actual experience that we've had in the past year as well. And that might help to sort of refine and make it a bit more accurate.
I think in terms of what we anticipated, a lot of the councils and universities and colleges found themselves with surplus cash at the end of the year, so decided more than normal, decided to pay in advance. Okay. Jones, are we happy to?
I've had my hand up for Chair, if I can ask my question. There's been mention already of performance fees in relation to that part of the investment management expenses. Chris Rule referred to that in his contribution. I'm not sure Jennifer Easton covered this or not. But my query is this: at the bottom of page 3 of the report, at bottom, it says page 39 on mine, overall page number, it says the fund's policy currently is not to estimate performance fees, since they are difficult to predict and can either be an expense or less often a reduced cost, etc., etc. And apart from the fact that they only come in apparently at the end of the year, nevertheless, would it not be a good idea just to review that policy sometime? Because should not the performance fees of the respective fund managers be geared to the expected performance of them, you know, a target? Could that not be looked at?
Yeah, and we can look into that, Chair, and evolve that policy.
I'd just like to contribute there on this point of performance fees. I think it's important to think about them more like profit share than fees as such, because obviously they are generally a sharing between the manager and the investors enjoying the balance of the performance. So that's why they're so difficult to predict. And we've had such a very active M&A market and quite a buoyant environment for some sales. A lot of corporate companies that have a lot of cash that has been driving early exits in the private portfolio. So that's been responsible for this kind of episodic, unexpected nature of performance fees, but essentially almost impossible to predict in that way. But I mean, obviously they're only seen when you would be enjoying performance on the other side.
Okay, any other questions? Are we happy to accept that report? All right, we'll move on to agenda item 8, which is the annual governance report, which the committee is asked to approve. I'm sure you've all read the detail. Any questions? Anyone? Jennifer?
Okay, thank you, Chair. The report's really good and really thorough. The bit that I was really trying to focus on, having to write these reports in my own organisation, is I can't see if we are doing amazingly or if we're mediocre. So in each section, it gives a response about what we've done, but I don't know, because I don't know how other pension schemes perform. Are we doing everything we possibly could? Are we just over the line? And if there could be some indication of what we need to do to improve, or basically how are we performing? Are we meeting, exceeding, scraping through? And then as a committee member, we can visually see where we need to improve, where we need to focus our efforts for the next year. That I would find that really helpful. Thank you.
Yeah, regarding the report, it would be good to add those enhancements, and there are broader discussions in the industry about governance and how we report on that. So I'd anticipate that for 21-22, we can do more of a review of the report and perhaps restructure and capture some of those points that you mentioned. Thank you.
Okay, we will look to take that forward. I know I've been in contact with a number of other funds, and I think we are pretty effective. And clearly we have the independent audit, both the external and internal audit assessing. And generally it's coming through a substantial assurance. There is one limited, but we're taking action on that. Any other comments? Are we okay to approve that document? Yep. Okay, thank you. Agenda item 9 is Lancashire Local Pension Board. And then I'll invite William in to basically give this report. Just to note that on the front page on the executive summary, that should be saying 2021. We haven't quite got to 21 yet. Okay, William, when you're ready, thank you.
Good, thank you very much, Chair. I don't propose to go through this in any great depth. For new members, I am the independent chair of the local pension board, and the pension board's role is very much to assist this committee. We are not an executive body. I actually want to, I'm not going to go through this in detail. I'll leave it for questions, but I do just want to make one amendment because it was pointed out to me last night that actually one sentence is not entirely accurate. So if you could turn to page 62 of the pack, 66 out of 304 on the electronic pack. And the sentence starts, the separation of LPP's administration and investment functions. I would propose to amend that in the following way to say the separation of LPP's administration and investment functions into two independent units, LPPA and LPPI, has led to some changes. The board is supportive of the decision to create two more focused entities and believes it will benefit the fund through more efficient service provision on both sides. However, we will remain alert to the need to assure ourselves that the fund receives value for money from the new arrangements, and then stop there and then leave out the last bit about my reference to IT and human resources, because it was pointed out to me that that wasn't entirely accurate. I apologise for the change. So with that, let me open up for questions.
Okay, anybody, any questions for William?
Thank you. This possibly might be a coincidence because I'm rather glad in a way that the independent chairman of the pension board, William, has drawn our attention to that particular paragraph. But apart from what I'm just going to say about it briefly, I would welcome something in writing about what William has just said, really. I think with respect, it's a bit late to then give us verbally what some amendment wording is to that paragraph. I think possibly it might be good enough to put in the minutes of this meeting, but it would have been better to have sent that round as an amendment because it seemed to be quite a few changes to the wording. But my query is this, one that William seems to have apologised for, that in the second part of that paragraph, I was going to ask for an explanation of this because it was news to me, that LPP had been providing such services as HR, human resources, to the fund. I didn't realise that had been happening. And I think that is a mistake in that paragraph, which I think is an example of a mistake in it that William is referring to. But the other thing I just want to comment on is in the first part of it, which William hasn't amended. I wouldn't like to think the wording is taken too completely literally about the two independent units of LPP administration and LPPI. Yes, they have quite substantial functions, and the role of LPPA Limited from last summer was certainly beefed up, if that's the right description. But from the onset of this successful partnership, known as LPP from April 2016, it was always the situation that there was the main board and there were the two subsidiaries, and that's what they still are. They are subsidiaries within the whole group, and there's still the whole group has the governance, the LPP Limited main board. I just want to point that out, that they're not completely separate away from the whole concept that we still have. Thank you.
Again, if I may respond to that, I agree. It would have been far more satisfactory to have been able to give you a written wording, my proposed wording beforehand. I'm afraid this was only pointed out to me late last night, and we agreed the wording this morning. I will send, in fact, I already have, but I will resend the wording to Mike, and maybe he can copy it to all members of this committee. I'm happy, if the word independent is better taken out, I will make that change.
I just wonder, William, if members are happy, if I take chair's action and agree the wording with William to go in the report, are we happy to otherwise accept the report that he's given? But I will clarify the wording with him. As William mentions, this has only come through basically this morning as a comment. So I'd like to just maybe talk it through with him and clarify the wording. Are you all happy at that? So happy to receive the report otherwise? Okay, thank you. Okay, thank you, William. We'll come back to you on that one. Okay, agenda item 10 is basically the pension fund intervaluation contribution review policy on the admission and termination policy. I'll hand over to Sean on this one.
Okay, thank you, Chair. The committee considered two policies back in March in this area. One of them was an amendment to an existing policy around administration and termination. And this is basically if an employer stops participating in the fund, and in some circumstances they could owe a deficit payment to the fund. The government introduced some flexibilities regarding that. So, for example, in certain circumstances, an employer could make payments over a period of time rather than one-off. The other policy was a new policy around situations in which an employer's contributions could be changed at a point in between the valuation points every 3 years. We went out to consultation with employers on this, and there were actually no comments that were received back. So the policies stand as they did in March when you looked at it, and the request is to approve the two policies.
Okay, any comments, anyone? Jennifer?
Thank you, Chair. So my question was around when an event happens with an employer, who makes the decision for this team to go in and review? And how significant does that event have to be to make a change? Because what we wouldn't want is the fund spending a lot of time with employers, and employers then finding that they're making decisions regarding the fund's going to come and get us if we do that. So it's just understanding what sort of significance these events would have to be.
Could I just clarify, is that in respect of both policies or one of them in particular?
It was particularly focusing on the first part, because the admission and the exit, we've been through that one lots of times. So it's the new element, which was the decision for contributions to be reviewed if an event happens.
Yeah, so there will be materiality or thresholds that we'd look at here, and we've mentioned them within the paper. We, in some circumstances, would be looking at, for example, if it was an event that affected more than 5% of the liabilities of the fund. So I think that's quite important to have that materiality level, otherwise we'd be looking at changing contributions quite frequently. The other thing is that in terms of when it could happen, we'd restrict it happening in the run-up to the valuation, because obviously it'd be too close to valuation point to do it then. And then in terms of discretion, that sits with the pension funds and the administrating authority.
Okay, are we happy to approve that? I think we basically approved it in March, but all happy? Thank you. Okay, we now come on to item 11, which is the investment strategy statement. And again, this came to the committee in March. Normally we would revise this every 3 years, but we've had a situation where one particular investment, Halo Housing, we've disposed of, and the investment panel met to redistribute the proceeds from that, which were £347 million. So basically, the recommendation was to increase global equities, credit and infrastructure asset classes by 1% each. So it's a minor change to the strategy, but a sensible one. And we did make a gain from the Halo Housing issue. So anybody, any questions on that? Yep.
Yeah, it's a couple of questions, Chair. I mean, firstly, the decision to sell Halo Housing. I just want to understand as a new member why that was taken, because it seemed quite an innovative vehicle for the fund to provide shared equity housing across communities across the country. And secondly, is there any plans to look at a similar dynamic to the London Pension Authority, where they're investing directly within Greater London? They've established what's known as a London Fund to invest directly in things like clean energy and affordable rent housing. Is that something that would be considered as part of the strategy? Thank you.
Yeah, I'll ask Ethan to just make a comment on that one. I mean, we have basically looked to invest funds in the local area, and we've done that on a number of occasions already.
Yes, and I'd also ask Chris Rule if he wants to weigh in, because they are more intimately involved in the sale of Halo Housing. But basically, it comes down to risk reward. The risk reward of that investment did not transpire to be as was anticipated at the outset, and every ingredient of the portfolio has to achieve a certain risk reward in order to be there. And the decision was made on that basis. It was also a slightly tricky governance situation that we needed to extricate ourselves from, and I'll let them explain. But just on the local side, yes, we do have a dedicated, it's more of an amount as opposed to a percentage, to local investment in the Lancashire area. And we would not, for example, be investing in the London Fund, but we do have a look to local impact through the real estate portfolio.
I'll just ask Chris Rule, and just apologies to Chris. I mean, he only came in late on, so a number of the new members won't know, maybe don't know, that Chris Rule is the Chief Executive of our local pension partnership. But I'll just ask him if he wants to make a comment about the Halo Housing issue.
Thank you, Chair. I think Ethan summed it up very well, actually. In terms of the second part of the question, the fund already has over £100 million invested directly into the county of Lancashire, and we continue to look at opportunities that are in the county of Lancashire portfolio. So the London Fund that was referred to by the member is a new initiative. The reason it's structured the fund is simply because there's some other London investors, so we have to have a fund entity around that. For the county of Lancashire, you've been doing this for many years, so probably a little bit ahead of that. In terms of Halo specifically, like many of these things, it's a kind of a balance between the assets that we own today, or you own today, and the opportunities you've got to own other assets in the future. And there was we took the view that there was a good opportunity to exit at a good price, and to redeploy that capital into other investments. To provide you some further context, you do have other similar investments in housing and other kind of socially beneficial investments in the portfolio. So Halo is not the only one, and I'm sure there'll be other opportunities to invest in the future.
Thank you, Chair. Just look at the way we structure our investment in sort of being post-COVID era. How are we going to look at how we structure our PET going forward? We can take into consideration sort of the change in working habits and office use and town centre use into how we do our investments going forward. Can you explain sort of how the structure will be and what considerations you've made?
Yeah, I know from the investment panel yesterday that discussions are always ongoing regarding up-to-date situations, but I'll let Ethan just comment on that.
Yes, I'd say for the past 15 months, we've been pretty carefully focused on that in our discussions with LPPI in terms of the COVID effect across the entire portfolio. You mentioned real estate and property in particular. What we've been focusing on is, again, the office portion, in particular, say student housing, rents out of the portfolio. Actually, we've been pleasantly surprised to see the income pretty well supported across the portfolio, which in circumstances like this has been a surprise. But equally looking forward, we would always ask the question about whether logistics will be a large proportion. Logistics are performing very well right now. There's been a huge demand for them. They have benefited from online shopping shifting, but that would be at the expense of high street retail. Similarly, grade A office space is clearly still going to be in demand. It's more of a kind of a placemaking, amenity-filled office that young people will want to work in, whereas B grade offices will clearly not be in this kind of demand. So those are the kind of detailed discussions we're having with the property team when we ask them about the opportunity set. So definitely we're aware of changing circumstances.
Thanks, Chair. Could somebody explain why I know it's only a small percentage, but it's still a significant amount of money, we increase global equities by 1%? Because it seems to me from all the discussions we've had, this is in terms of our responsible investment portfolio, this is the area that we have least control. And we have, I think, prided ourselves on the fact that we keep global equities to proportionately lower than most other pension funds, and it's something we seem to do well. So if my memory serves me right, actually we had a lower, we've actually increased global equities as a proportion in the last round of the investment strategy. So it just seems a shame for it to go up again. And yeah, so the rationale for that, why we weren't looking at perhaps just dividing the increase to the other areas that we increased.
Yes, certainly. So that's a very good point. I'd say at 45%, which is our new target equities, we're still very much, I'd say, at the lower end of most of the LGPS peers. Some will have up to 70% equities. So we want to ensure that we're still participating in growth, and equities are certainly at the epicenter of growth today. A 1% allocation is not a huge amount. But when it did come to distributing that 3%, we looked across the entire opportunity set. And it's fair to say that certain areas such as real estate, because of the points we just made, the opportunity set does not look perhaps as strong as it would have pre-COVID. So that wasn't attractive. Fixed income is not very attractive if we're looking at an inflationary environment. Equities do provide inflation participation. They're not perfect, but they tend to participate. So the decision was that, we already have a lot in infrastructure, but we'd like to keep a little bit more. Credit is of interest, but we have a lot. So we did not want to stack too much in these areas where we might be challenged to get capacity. And in global equities, we can always get capacity. And quite frankly, in a year like we've just had, we would have done better had we been like our peers at 60, 65%, because that was the engine of all returns. So I'm quite comfortable that 45% is not overly exposed to equities. And I'll address the point about just ESG and control. Actually, in my piece, I have a specific section about engagement. And I'd say, yes, there's not perfect control, but that is an ever increasing and improving situation.
Okay, Councillor Bower.
So just a quick one, Chair. I mean, I don't want us to get ahead of ourselves, but I do think it would be useful to have a slot on an agenda to discuss the post-pandemic impact on our investment portfolio. If we could have an open-ended discussion, because I think it's probably too early now, but I think the point will come in the next 6 or 9 months when we need really just to have a detailed look. And normally in terms of our investment portfolio, it's little tweaks. I suspect it may be more than a little tweak post-pandemic, and I think it may be worth having a more detailed discussion by committee members if officers and advisors feel that would be useful, but I certainly think it would be helpful for me. Thank you.
Yeah, okay, we'll have a look at that, because the other thing going through my mind is basically we could have a training session on that scenario to give people the opportunity, to give our advisors the opportunity to outline what we take into account, and then for members, and particularly for new members, to ask the questions. I think the other thing to point out is also that against every heading in the investments, we do have a tolerance. So the tolerance, for example, in global equities is anything between 40 and 50%. You know, that gives a bit of flexibility to LPPI to, you know, alter the figures as we go along, depending on the market. That. Right, thank you. We'll on to item 11, which, no, sorry, I'm going back. Item 12, which is feedback from members of the Committee on Pension-related Training. And I'd just like to say to all members, particularly the new members, you will get lots of opportunities to go on training sessions. Mike here sends through quite often, you know, various bodies hold training sessions for different elements of the pension funds. And by all means, put your names forward to go on some of these training sessions. They are very useful. We also hold a training session internally every 2 months. And again, like I mentioned there, it might be worthwhile having something on the investment strategy. But if members have a feeling that they want a particular subject to come up, then by all means, you know, let us know, let myself know, let Sean know, let Mike know. You know, we usually get very good attendance at the internal sessions. We include also the local pension board, so it's an opportunity for members of the committee to meet up with members of the local pension board. Hopefully will be made easier in future rather than the IT scenarios we've got, but we'll see. I don't know if clearly most of the events, I'll ask Paul if he wants to mention anything about PLSA conference, because Lizzie is no longer on the committee.
The PLSA conference, it is good, but I must say this year's wasn't as good because it was all done remotely. But the range of topics that they cover was quite broad. And the other advantage was because they recorded the sessions, you could actually go back. So if I was interrupted on a couple, so I could actually go back and finish it. So that was one advantage. But I would recommend anything that PLSA come up with for people to take a look at.
Yeah, I mean, I would agree with that, although unfortunately the county council let me down a bit because I couldn't get the IT working on one of the days. But generally you get a wide audience at the PLSA events, and they are well worth going to.
Yeah, and just for your information, ladies and gentlemen, I've been asked to let you know there is some training being arranged on audit risk and governance committee to do with the statement of accounts. It's on the 23rd of June from 2 o'clock. My understanding is a link for that has been circulated to county councillors. I can also make that available to the cooperative members who are on the committee. So after the meeting, I shall be sending around an email for you.
Very quick comment. A lot of the training this time has been online, and if we could try to preserve that in some circumstances going forwards, it's really good. So some of the sessions that are particularly slide-based where it's a presentation, it's great to be able to just watch them, and then as Paul says, rewatch them later. And I think sometimes if that was available going forwards, you'll get more attendances, whereas if it's a discussion, it's better when you're together. But if we could preserve some online, it'd be really good. Thank you.
Yes, I think perhaps one of the benefits that have come out over the last year of the remote working, especially with regard to the workshops, is that we've seen an increase in terms of engagement. So it would be my intention to continue that regardless of the social distancing restrictions. You know, if that eases more, I think there is merit in continuing to make the workshops available remotely. As you've mentioned, they are also recorded, and then the slides and the recording made available, as was done with the induction session recently, is made available to you through the secure online library. So we will be continuing with that.
Okay. I think at the back of the report, you can see the range of, you know, basically training that people can go on. So please bear it in mind. Can we move then to agenda item 13, which is responsible investment report? Clearly, this is a very important area for the fund. There's a very good report at the back. The lead for LPP on responsible investment is Frances Deakin, and she now has a couple of people working with her. So it's taken very seriously at the LPP level. I'm also a member of the executive of the LATFO, which is Local Authority Pension Funds Forum, and responsible investment is very high on the agenda there. We have, for the new members who don't know, we have a responsible investment policy, and it's actually due for review this year. So I'll come back onto that in a few minutes. But if anybody wants to ask any questions about the report.
Yeah, thank you, Chair. Obviously, it's a good statement in terms of what we want to achieve in terms of responsible investment, but is there anything about tax avoidance? Because I noticed a lot of the equities the fund chooses to invest in one of the reports I've seen actually have been publicly called out for not paying the level of tax that the law intends, Chair. So I'm wondering, does that come into the responsible investment strategy?
Yeah, so in the responsible investment policy, you'll know that we cover ESG, which includes governance. That's the G really. So that would look at you know, the companies, for instance, that we invest in and how they behave, and one aspect of that would be things such as tax avoidance.
Okay, Councillor Dowding.
Just to say, Chair, we have the windows open on this side where we have this terribly noisy truck, and then the windows closed on that side. And I wonder whether, if it's not too late, we might swap, because that is really piercing. Oh, it's just stopped. Yeah. Thank you. Sorry about that. So I have a question which I think has been asked before. And it just refers, it comes back to the point that Afin just made about our engagement strategy and the reference to the work of LAPF. But in the report, and maybe you can remind me why this hasn't changed, because we pride ourselves on engagement as a committee, even though some of us don't think that we're getting very far with that. So we're banging our head against a brick wall, spending lots of time engaging with not getting many results in terms of real effective change by these major corporations. And when we've got shareholder voting, we continue to report on the proposals voted on, but we don't actually say which was successful. And I know we've discussed this before, but I feel as though if we're going to actually have some transparency in investing time in shareholder engagement and our voting responsibilities, then we really should see whether it's having an effect. And what we seem to just get is how we voted for and against, but not what the ultimate result was. Because I've been on the committee, as I said, 8 years, and for me, I don't think we see a lot of change in the issues, and yet we continue to use that as one of our major ESG techniques or plans.
Yeah. Oh, okay. I will ask. Yeah, the noise is pretty bad. I will ask Chris Rule to make a comment on that, but I'll make a comment from the LATFA point of view, and I'm more than happy to let you see some of the information that comes from LATFA, that some of the voting is having an effect. We've certainly changed the minds of a number of the bigger oil companies, for example, that have changed the policy on responsible investment. So I'll look to what I can find on that and circulate it. Chris, do you want to make any comment?
Thank you, Chair. Yeah, just briefly, in the RI report that Francis and the team prepare, we will call out some specific kind of, not quite, we don't label them case studies, but there's some examples in there of particular themes that we voted upon. And there, where the company publishes a result, we will publish the result in those themes. So in a couple of them, you'll see result not disclosed. That's not us not disclosing that to you. That's the company hasn't disclosed the full result. I'd agree more broadly with the Chair's comment that there are kind of signs of engagement working. If I look at the more detailed supplemental pack, I think you should have access to on the Robeco engagement report. There's again a few themes there. We don't expect 100% success, but what we do see is companies evolving. And I think particularly the success of engagement with US companies on themes around climate change and reporting around climate change has seen a marked change in the last couple of years. One of the biggest challenges we have is if you like, climate change not being taken so seriously in the US until the recent change in administration. What we've seen though is US companies increasingly coming forward and providing the kind of information we need to be able to measure what's happening. So there are signs of progress. On the full voting results, obviously we vote in thousands of different occasions, and it'd be quite a matrix to try and provide you the full results of every vote that we vote in, which is why we try and pull out those different case studies every quarter.
Okay, thank you.
Yeah, don't we just push a little further, Chair, just in terms of the requirements we do have as part of the strategy. So obviously I referred to tax avoidance before. I mean, a lot of the companies just continue to do it, i.e. as they do in you know, invested in fossil fuels and other things. When does it come to a position as a committee that we say, well, we've been asking for this change of behaviour for so long, so many years, and we're going to potentially look somewhere else to invest? You know, is this covered within the strategy? You know, because we have done very well, for example, on, you know, divesting from fossil fuels, but other pension funds have got down to 0%, for example. You know, so I'm just saying, when do we actually get to that stage where we say, we've asked you for a change of behaviour, that hasn't happened, it's not meeting the policy, and we want to invest our money somewhere else?
I think, you know, basically the main purpose of the fund, and Councillor Dowding will have heard me say this before, is basically to ensure that we have enough resources to pay the pensions of all our members through, you know, as long as that's required, and to cover our liabilities. Whilst responsible investment is a very important aspect of the pension fund, the first item is basically to ensure we pay the pensions. So, you know, there's a lot of work being done on responsible investment. We do clearly, LPPI are the ones making the investments on our behalf. And again, I'll let Chris come in and make a comment, but they are certainly pushing the boundaries on RI, and you know, we will continue to push them as you know, as a lot of other funds are doing, but total divestment is not always the best answer for the fund. Add anything to that?
Sorry, Chair, it was addressed to me. No, nothing to add. I think you summed it up. The only other thing I was going to mention, which might be of interest, and I'm very happy to kind of do a longer training session, there is a scheme advisory board, responsible investment group, which has been set up. Frances Deacon, our head of RI, is a member of that. She's one of a handful of representatives. We've put a reference to this at the back, and there are, the first part of their work has been around definitions, and very happy to take some feedback from members and feed that directly into that group. But that group, if you like, is trying to kind of address some of the, if you like, harmonization of approaches and making sure that everyone's comparing apples with apples. So I guess I'd probably challenge the view that there are many funds, if any, that are zero exposure of any sort of substance. I think what you see in the reports that we provide is the Lancashire Fund is already very low exposure to things such as carbon. If members have access to the previous meetings reports, we annually kind of give you data against the Paris Accord climate pathways, and the fund is well below the 1.5 degree pathway, let alone anything above that. So the fund's very well positioned already, but of course we don't want to become complacent, and so we continue to try and extend and raise that hurdle, raise the bar, as it were.
Thank you, Chris. And I just want to say, I think we appreciate that we've made leaps and bounds in terms of our responsible investment and the way it's presented, and that's all really appreciated. And I wanted to just acknowledge that I do appreciate this, the reference to the issue of investment in companies in the illegal Israeli settlements in Palestine. So I appreciate that was referred to. One of, and I hope that we can continue possibly to get a little bit more information on that and see how that progresses. But one of the things that under other relevant areas that you mentioned, or whoever wrote the report mentioned, is this issue of the government considering new legislation to stop public bodies from imposing their own approach to international relations. And notwithstanding the chair's comments about our primary duty, I think we have to acknowledge that one of the successes of our fund is our excellent reputation, and there are huge reputational issues if we are supporting companies that are engaging in illegal activities according to international law. So I think at one stage in the past, the government was also proposing to restrict local authority decisions around this kind of issue to do with what they call foreign policy. And it was in the end ruled out. And I think we made a representation that we should have the freedom to judge what's best for our reputation for the fund. And I wonder whether we might consider doing the same. My understanding is that new legislation is actually under the Police Crime and Sentencing Bill that's still going through Parliament, where it's seemed to be all about protest, but actually they've snuck in a little bit there, which again is about trying to curtail the freedoms of local authorities to set their reputational practices and standards.
Yeah, I think if I can comment on that. Basically, I haven't actually seen the new legislation as yet. Anything coming through on that. I'm very well aware that the last time they tried it, it was thrown out by the courts. So I'm sure when we, see anything coming through, then we will basically have a look at that and bring it into the conversation with members. Okay.
Mr. Chairman, can I
just go.
Yes, I know you mentioned earlier you're going to come back on responsible investment, and as it says in the report, the idea is to have a relook at this pension fund's responsible investment policy. which according to the report was last updated and approved sometime in 2018. What my suggestion would be is that, and I'm surprised, in fact, that we didn't have appended to this report a copy of our responsible investment policy. I think it would be useful, although I have to acknowledge that at the end, at the very end of the papers that agenda item 11, investment strategy statement that we've already looked at, right at the end there, it gives a link, a computer link to it. But I'd prefer as well if it could be sent out, please, if you agree, to members, all members of the present committee, so they can see what the present policy is.
Yeah, I did pick that up, but obviously too late. We will send that out. I think it's available on the library. It's in the library. I think all members have access to the library. If anybody's not sure how to get in, then again, go back to Mike. Mike has also reminded me that normally before the pension committee, when we're back hopefully to normal, we would have a half-hour presentation session on various subjects, and it may be that responsible investment becomes one of those subjects, hopefully in the near future. Just going back to the update of the responsible investment policy, we want to set up a task and finish group to basically look at a revised, if it needs revising, and look for some volunteers to take that forward. So Councillor Dowding has volunteered. Any others? Councillor East, Jennifer Eastham, Councillor Wesley and Councillor Schofield. I'll let you discuss that. And Councillor Brown, yeah, and at the back. We've got everybody. We will probably look to a maximum of 4 people on a group to look at this. We will set out some terms of reference and look for the group to come back at the November committee with a whether it's amended or not, responsible investment policy. Okay, so we'll take that forward. Mike and Sean will take that forward in the next few weeks. Before we move on to the next section, well, I'll just mention urgent business. I haven't had any urgent business, not been notified of anything. But I've also noted that, and you'll see on the screens, that Michael Higgins has joined us, and for a lot of new members, Michael has been chairman of Local Pension Partnership since its inception in 2016. And Michael is basically leaving the group at the end of June. So I'd like to welcome him to this meeting and also thank him on everybody's behalf for all the excellent advice and work he has done for the fund over the years. I think, you know, the partnership between ourselves and London has been a great success. From the initial level of funding for Lancashire of 5.5 billion, we're now at 9.4 billion. So I don't think anybody can argue that it has been a great step forward. So I'll just invite Michael to say a few words, really, before we go into the part 2 and a number of people maybe leave us.
Thank you very much, Chairman.
You may have to speak up, Michael.
To have had 6 years chairing LPP. Sorry, rural broadband connectivity is still an issue down here. It's been a privilege to chair LPP for 6 years, to see the assets grow from 10 billion to 20 billion, to see the staff develop the way they've developed. And I thank you very much for having given me the opportunity to chair this. I think you've got a very strong leadership team in LPP now, and I'm confident they'll be able to take things forward very successfully. So many thanks.
Any questions, comments? Councillor Barrow.
It's nice to see you, Michael. Although I'm with a different hat on this morning as a city councillor rather than a county councillor. But I do remember all the meetings we had to set up LPP in 2014, 2015 with the shadow board before we actually got going. So I've been out of it for most of its existence, but I've seen the work it's done, and thank you very much for your contribution as chairman. I hope you enjoy whatever you've got to go and find time to do in the future. Thank you, Michael.
Councillor Schofield.
Thank you, Eddie. Yeah, I would endorse everything that Councillor David Borrow has just said. I, like him, and Eddie, in fact, as well, and one of the others, were privileged to be part of the initial meetings that took place ahead of the successful launch in April 2016 of the Local Pensions Partnership, as it became known, which was and still is very much a pioneer. All right, the London, so-called London Civ might have been the first pool of 30 odd members, but we were the pioneer LPP, the successful partnership between LCC and the local LCC Pension Fund and the London Pension Fund Authority. And the service and contribution that Michael Higgins has given from the very first time he was appointed back in, I think, summer or autumn of 2015 has been no less than exemplary. And we are very grateful to you, Michael, and very best wishes for the future.
Many thanks, Alan and David. I greatly appreciate that. And I have to emphasize that the support of the council in allowing us to develop the group has been vital. And I think we have been very lucky in having Lancashire as one of our shareholders.
Okay, thank you for that, Michael. Right, we will move on now. Date of next meeting is the 17th of September at 10:30. And we now have to move on to exclusion of the press and public. And I'm also going to suggest that we have a 5-minute break before we go on to the part 2 items. Okay, thank you.